Thanks, Noel. And thank you, ladies and gentlemen, honored guests, for joining us for the second half of the last day of our 10th anniversary Invest ASEAN conference here. Fantastic to have you all. Hope you had a good lunch, as Noel said. Just to put some faces to the names, David Forsyth, head of Maybank Prime here in Asia. On my left, your right, Yong Yi, CEO Tahan, Suhaimi, CEO of Quantedge, Willie, CEO of New Silk Road, and Andrew Hudson, Trivium's head of business development here. In a minute, I will hand over to each panelist to give a brief introduction of themselves and their experience. This is important so you understand what they bring to the table, but in preparation for this, I did my research, did my due diligence, I did my LinkedIn online stalking, added up the years. There's over 100 years of markets experience here, and I'm rounding that down a little bit. What you have in terms of macro, global macro, fundamental, credit-based but multi-strat, and Andy's background on the platform, but also as an allocator in the region for over 20 years, is a wide range of experience, a wide range of strategies. So with all of this, we should have a good sense of how to look at the different opportunities in Asia, ASEAN, and globally. We'll discuss a range of topics going across the evolution of Asian markets over time, securities opportunities and how to trade these different markets and different underlyings, geographical nuances, the evolution of the investor appetite, some macro and geopolitical considerations as well, and hopefully the insights gleaned from all of this will help all of us understand better how we can win using alternative strategies. For the other panels, I will at some point be given an iPad, I think, for Q&A. So I'll try and keep it as interactive as possible at that point. So if there's anything that's relevant to the conversation, I'll try and get those questions in. And we'll leave some time at the end for Q&A and hopefully get through as much as possible. So to kick it off, Yong, if I can give it to you for a brief introduction of yourself and your experience, please.
Hi, I'm Yong Ni. Good afternoon. I run Tahan Capital. Spent 16 years at UBS before, worked in many different centers. Last, I was running the global emerging market credit business. So Tahan been around for 14 years. We do only credit, and we do both public credit and private credit. Public in terms of bonds, the high yield bonds, the converts, the bank cap, AT1 that I'm sure you're all familiar, and private in terms of lending, with obviously security, collateral, and well-structured covenants. So for credit investor, we tend to look at a much longer term cycle and its behavior. So we'll pay attention to things like global debt level, the banking system, balance sheets of the world, earnings and cash flows, and that's how kind of we look at opportunity. Thanks.
Suhaimi?
Thank you. Good afternoon, everyone. Suhaimi from Quantedge Capital. So I'll tell you a bit about who we are, what we do. I mean, we're a quant fund. We've been around for 16, close to 17 years now. So that means we started in 2006. Probably one of the first, definitely the first in Singapore. I think probably the first in the region to apply quant investing in a fund. And today we manage about 2.5 billion, 2.6 billion worth of capital. And we've compounded investor capital about 16, 17 times since the beginning. But we run one single portfolio, we're basically just a one product firm. And what we do, as the name implies, right, we're applying quantitative techniques, so statistical tools, to decide what we invest in, to construct a portfolio, and it results in a highly diversified investment portfolio that invests in over 250 different markets today. So that's essentially what we do.
Willie?
Thanks, Maybank, for having me here. My name is William. I basically spent half my career working out of New York, first in investment banking, then private equity. Actually came to Asia running an Asian fund of hedge funds, and that's how I got to know many of the people here on the panel. Since then, I've moved over to the fund side, and today I'm with New Silk Road. New Silk Road is basically a fundamental equity investor. We currently have 4 different strategies, all adopting the same philosophy of very long-term bottoms-up stock picking. concentrated portfolios. We have an Asia ex-Japan regional strategy, China equity strategy, a China mid-cap strategy, and then an ASEAN equity strategy. And we do that with 20 people based here in Singapore and in Shanghai. Thank you.
Hi, my name's Andy Hudson. Thank you, David and Maybank, for inviting me along. I'm with a group called Privium. We're a global investment manager. We have around $4.4 billion in assets under management. But the model's a little different to my colleagues here. We work with, on the whole, new investment managers to get them up and running. We offer a licensing regulatory framework and an opportunity for managers to come to market in an accelerated manner. My background, my journey was, I've been in Asia for 20 years, originally with a global fund of funds as an allocator, then around a decade with a venture capital unit of an Australian bank that was seeding hedge fund management businesses. More latterly, made the move to Singapore, having been based in Hong Kong, and now with Privium. So fairly new to the team and to Singapore, but been around in Asia for quite a time, and very passionate about seeing talented investment managers thrive and provide the right investment solutions for people who are interested in capitalizing on the Asian opportunity.
Thanks, everyone. Just because we started this end this time, I'll go straight back to you now, Andy. But in terms of Asia, say since late 90s through the noughties up into modern day, how would you, having looked at it as an investor, how would you describe the landscape change over time, and obviously how that has, what that's meant for the hedge fund managers that you've encountered over that period?
Yeah, it's interesting. I think the one word is growth. So we've seen phenomenal growth in the breadth and depth of the markets across the region, and growth in opportunity as well. I think in terms of what that opportunity set involves, I used to look at Asia as an investment in Asia as really, you've got non-identical twins at one time. This is in the early 2000s. So you would look and you would say, well, there's a whole part of Asia that's sort of dull and very deep, and then there's a part of Asia that's racy and quite shallow. Dull and deep would probably be markets like Japan, Australia, where there wasn't a great deal happening, but they were very developed markets. They were very deep markets. And so there was always an alpha opportunity that could be extracted from those markets and the dynamics around it. On the other hand, you had your sort of racy and shallow, whereby you would really come for outsized returns from those markets. The markets were shallow. Liquidity was always going to be something that you were fighting against. But again, if you could blend a portfolio in a harmonious way, then you were able to get the best out of the region. So that was the story in the late 90s, early 2000s. Always, as an allocator, unfortunately, having an eye on the exit, because at that time, emerging markets would tend to trade on a 3-year cycle. But over time, then markets did develop further. China's entry into the WTO opened up an entirely new landscape. Many of those racy and shallow markets became much deeper, but nonetheless racy. And so good returns could be generated. And I think the growth of the China markets was hugely important. I was investing at the time in the same way as Willie was investing in hedge funds. And the balance of allocation at that time, 2/3 of the hedge fund industry in Asia consisted of Japan managers. And that all reversed over time as capital found new opportunities. And through the 2000s, the balance tipped to being 1/3 Japan-focused managers, 2/3 Asia ex-Japan, big emphasis on China. So we've seen the markets develop over that period of time as well, always able to find good opportunities to invest with smart strategies, and that's only developed. So that would be my experience of the markets through that phase. Happy to pass it on to somebody else if.
Well, I'm aware as well that Suhaimi Quantage has a global perspective. So before we zoom in on Asia Pacific and even ASEAN within that, maybe if you could take us to a top level and say, again, you can dial it back into Asia and what's happened here, if that's possible, but talk globally over the last sort of 20 years, how you viewed the market's development, especially over maybe the last 10 years where you've been sat at Quantage as well.
Well, just quite generally, your original question was how it's developed since the 90s, and I was thinking back, what was I doing in the 90s? Still in school, playing sports, trying to get away from class probably. But obviously, markets have changed a lot. I mean, I do want to focus on Asia and say, we're a global macro fund. We're invested in so many markets across the world, across many asset classes, right? Equities, fixed income, commodities, currencies. We even have a reinsurance slice. And Asia is sort of becoming a bit more, I wouldn't say prominent, but it is playing a bigger and bigger part in the portfolio. We just in our equity slice alone, which is just a small part of our whole portfolio, but within that, we're at any point in time allocated into 40, equity futures indices, right? And in the past that was much smaller, right? We started with maybe 10 markets, we're now into 40, and today 25% of that is in Asia. Right, so it is certainly an area of growth. I mean, Asia, not just as a market, but as a marketplace. I mean, we're talking about access to Asian equity markets that are, delivering good sources of returns. We are expanding our commodities portfolio into quite a number of commodities contracts that are on Asian exchanges. I mean, we're talking about iron ore, palm oil, all this kind of stuff. So I would say it's an exciting area of growth, not just as a market, but as a marketplace. Of course, we'll probably touch on this a bit later about the investor pool that is in Asia. I mean, and that's another interesting and important area of growth.
Understood. And then maybe to pick on one strand in that, but credit, Yong, in terms of how you've looked at the credit markets over your time in Asia. It's obviously deepened and broadened, but what would you have to say across the different geographies and markets here?
So the Asia credit market really came to life after the Asian financial crisis. So if you remember in the 80s and 90s, Asia broadly is an FX market and also a local equity market. And then we have the AFC that took everyone down, and then it got born again after 2003. And from essentially 2004 all the way to 2 years ago, the credit market has just been growing on the back of three things. Number one is cheap money in the world. Number two is China growing, and it became a very big component of the issuance. And then number three, obviously, the household savings are all seeking for income, and as a result, they have to grab bonds yield for performance. But the cycle starts to get challenging the last 2 years because of rising rates, number one, and obviously some of the issues happening in China, and that we're seeing some good pickup in default rates. And obviously in the most recent time, the Credit Suisse Bank Cap AT1 is also adding volatility into the market. So I do think that the market going ahead is going to be a very different market that we saw the last 15 years. Credit is going to change. It's no more going to be a fixed income product. In the next 5 years, credit is going to be an opportunity product. You have to focus on dislocation. You have to look at event, situation, distress, private financing for opportunity. So that's a big pivot. And a lot of, I think, fund managers is trying to adjust to that pivot thing. Thanks.
Thanks, Yong. Willie, I guess you could wear both hats here. You could talk about how you saw it as an investor originally, and then from New Silk Road perspective, how that's developed over the last 10, 12 years.
Sure. I won't comment too much because I think Andy covered it really well as an allocator, but our business at New Silk Road has really evolved, I think, as the markets have evolved. We never envisioned to have different strategies when we started our first Asia fund, but our investors led us to take the approach we take, fundamental investing, but with the inclusion of A shares and MSCI. And at that point, they were talking about much larger inclusion at one point. More institutional investors wanted greater China-specific funds. The same investor wanted us to start a A-share mid-cap fund, so we did the same thing. And then likewise, other large allocators wanted a ASEAN-focused fund. And so as the markets deepened in ASEAN, and we're particularly interested in markets like Indonesia and Vietnam, which many people talked about yesterday, we found ourselves being able to apply that same approach into these newer markets. So that's how we've evolved over time, and that has to do with these markets deepening and the ability to invest in really interesting sort of mid-cap companies across these different markets.
Thanks. And I think maybe to come straight back to you, because it talks to one other point that I wanted to land on in terms of liquidity, which obviously tends to evolve in lockstep with maturity of the markets.
Sure.
What's the interplay there, especially when investors look at you and talk to you about liquidity risk and how you manage that within the portfolios?
For us, really keeping the size of the funds at a reasonable level is really, really important, because we don't want to gather a lot of assets and then grow to a point where we're no longer able to run concentrated portfolios. And for us, concentrated portfolios means top 10 names can be 40 to 50% of our portfolios. And included in some of these names are actually mid-cap stocks. As many of you know, in ASEAN, that is quite a challenge to be able to run a reasonable size strategy in the same concentration. So for us, it's about watching these markets evolve, but we're able to build positions in Vietnam now. We have 3-4% positions in 3 or 4 names in Vietnam, whereas 5 years ago we had 1% Vina Milk, like many others did. So that's definitely evolving, and as we see more liquidity come in, and hopefully with the support of a lot of the domestic institutions within Southeast Asia, we'll be able to increase the sizing of our positions throughout some of the less liquid markets. China has always been very liquid, and North Asia in general.
Thanks. And so Jaime, maybe the same question to you, but in terms of, you've already said you've put 25% in Asian equities, I'm guessing more liquid, but in terms of how you look at Asian liquidity and then as part of the global picture?
Yeah, I think it's been mentioned a couple of times in this conference, right? This question about liquidity of the Asian markets, and it's something, I mean, most of the speakers have lamented and said, look, we would do more if it was a deeper market, if there was more liquidity, and I would say the same, because we're participating in equity markets in Asia, but largely at the index level. I mean, we have, for example, an equity long-short strategy. We are buying single names, but in that respect, we're largely doing that in the more liquid markets. So the Asian markets, we don't have enough liquidity there to do that yet.
Is that a question of ability to short and hedge, specifically at the name
Absolutely,
level?
yep, that's right.
Yong, from your perspective on the credit side, I know you express yourself through multiple asset classes, and you touched on privates as well.
So credit is always going to be a bit challenging because it's an OTC product, so it's never going to be as liquid as equity or FX. But I would say that liquidity today is very much reflected in the price volatility. The big difference today versus the GFC was that most of the sell side, the banks, the market maker, the appetite for risk is actually quite low. So as a result, they don't warehouse lots of risk. And as a result, you see a lot of price volatility. But the price volatility is also quite good, because when it gets to the right price, liquidity will come back into the market. So it's got a lot more tricky, but I wouldn't say that this is a market where liquidity doesn't exist. In GFC, that was the kind of moment where you will struggle to sell anything or buy anything. But today, it's just a lot of price volatility, but it's still relatively functioning.
Thank you. Maybe to sort of come up a level, and we mentioned, or I know a lot of people have talked about geopolitics and macroeconomics here, but maybe land on a couple of those and just get the view of practitioners in the market. So maybe starting with rising rates in the US. Are we near the top of the cycle? I'm not going to do a poll and ask your views, but getting a sense of where you think that sits and what the interplay of that might be with Asia. Yong, because you're the credit guy, maybe start with you on that one.
Okay, I'm not a rates expert, but I think most part of the aggressive hiking is probably done, but we might get what we are now observing in Australia and Canada, where they are going through a pause, hike, much depend on data. So there will be some volatility as a result, but certainly not really seeing a big slowdown that will lead to any policy easing. So I think in the rates world, it might be stuck in this kind of backdrop. In terms of cycle, I mean, I do think that we are in a very late stage of a cycle, meaning the economy are broadly slowing down, but it's not slowing fast enough for policy to ease. So policies are relatively tight for now, and as a result, there's a huge refinancing cliff coming out. Guys that have borrowed money and they need to be repriced to the right level, and as a result, I do think we're going to see a pickup in default rate broadly. But back to the point about geopolitics, I mean, that is where I think it's some of the bright spots we're seeing, which is because of the geopolitics, we are going into a multilateral world, unlike the globalized world that it used to be. And a big beneficiary will essentially be India and ASEAN. And ASEAN in particular, Vietnam and Indonesia. So we're beginning to see good companies coming out from these few places. Hopefully they will get their bond ratings and issue bonds and be able to fund themselves for their future capex. So I think it's one of the few bright spots today in the broad landscape that we're seeing. Thanks.
Thanks. Maybe Willie, come to you, and I guess Yong's now gone to geopolitics as well as the rates
Sure.
question, so you can pick and choose.
Yeah, and again, I'm sure you've listened to many more people who can opine about U.S. interest rates than me, so I'm not going to touch upon that. But what we are seeing is that we think Asia is in a very different cycle in many cases, especially countries in ASEAN. And I think the companies that we have in our portfolio, which generally are consumer-oriented companies, are actually in a great place right now. So they have suffered in the past because of inflation, a lot of commodity price rises. Consumers were weak just coming out of COVID at that point, so they were slowly raising prices but weren't able to raise prices as fast as they historically would be able to. They have dominant market shares. So finally they're able to pass through, and now with commodity prices moderating, their margins are really going to expand over the next couple years. We see this as a strong, very strong earnings cycle for a lot of the consumer companies, particularly around the ASEAN. And I think, as many have also said yesterday, ASEAN is used to higher inflation. I mean, in Indonesia, in the Philippines, Vietnam, these higher inflation numbers are not unusual as opposed to the developed world. So I think consumers are better able to tackle them. And frankly, for most countries, we've seen currencies being more stable than historically was the case in big rate hikes in the Western world. So overall, we think that ASEAN and ASEAN companies and consumers are maybe in a very different place than developed world consumers.
I'm guessing that thesis is bolstered, or the tailwinds are supported by the demographics in the region as well.
Very much so, but even on the short-term basis, setting aside the 10-year story, we think on a 2-year, 3-year story, there's going to be a lot of great companies that will actually be a great inflation play, in the sense that they will benefit greatly from if you believe in 5, 6, 7% inflation, because these companies grow as part of consumer price rises.
Understood. Andy, maybe to you on this one. Again, I'm not sure if you want to talk about the rate cycle and where that may go for the region, or if you want to sort of land on a couple of the geopolitical things.
Well, I guess both of those, David. Historically, if we thought we were reaching sort of the peak of the rate cycle, that was the dog whistle to put up risk in the portfolio, and that was when external flows would come into the region. I think it's a little bit different this time. I think there are other factors at play, and the geopolitical situation is perhaps inhibiting animal spirits, even should rates begin to come off. And I don't necessarily subscribe to the fact that we're at peak rates at the moment, but it may not have the same old impact that it had in the past. I think the geopolitical question is strong. I think there is this bifurcation of attitudes around the world, and there's a lot of fear about what the political climate will entail, and that is, to my knowledge, beginning to affect investor appetite externally for the region. That's not to say that there isn't a huge pool of manufactured wealth that is now at play in the region that is just not subject to the old rules. And I think both William and Yong can probably speak to that, and Suhaimi as well, in terms of what they're seeing with their own investor base and inquiries.
Thank you, and we'll get on to the investors in a second because it obviously plays into the geopolitical considerations also. But staying a little on the markets at the moment, Suhaimi, if you were looking at your portfolio globally, if we're looking at the dislocation from a geopolitical perspective, do you start thinking of two different spheres in the world where you'd be trading, and would you operate that way, or would you still view it as not necessarily business as normal, but managing the risks in similar ways?
Well, we are a quant fund, so we're just looking at the numbers, really. I think at the end of the day, it's a single portfolio, and we are allocated broadly. So I wouldn't say we would split that up and say, look, we're going to trade more in one sort of market rather than the other. But of course, as risks of whatever sort of escalate, I mean, it's usually reflected in the market through volatility, right? Investors are uncertain, and as a result, it makes the market or the particular strategy less attractive. So from time to time, this happens in every single market, right? When you think about it, and there's always geopolitical risk. There is always some tension, some flare-up, some hostility somewhere in the world. Sometimes it makes the front page news. Sometimes it doesn't. But conflict happens all the time. I mean, that's the reality. And we are obviously attuned to all this in the sense of looking at the markets and how they react, and we pull capital away from certain markets when they become less attractive, and so on and so forth. But at the same time, we're still broadly allocated across all the global markets.
Understood. Just to link back to the investor question that was touched on there, Yong, you've obviously dealt with investors from sovereign wealth funds at inception of Tahan through to modern day. So what have you seen evolving over the last 10, 12 years?
Okay, so when I talk about pivoting, I'm also seeing the same among investor. I would say that the last 10 years of fund flow that came to Asia, particularly all this big US endowment and pension, basically in a zero interest rate world and a QE world, that is clearly going to reverse. I mean, on top of the geopolitics, because in a QE world, a lot more money is available. Everyone AUMs goes out, and in a QT world, it does the opposite. And also, a lot of the money that came from retail, where interest rate is zero, and then they have to seek for income, I think those fund flows are also going to slow. Because what we have is essentially FD rates or MAS bills anywhere 4, 5, 6%. And it's quite easy for a lot of retail guys to access to this product. So I think the main fund flow, the last 10 years that have fueled the industry, is probably going to moderate. But on the other hand, I see new engine coming through. So the local institutions, i.e. the Asia or ASEAN insurance company, the endowment, the pension funds, they're all stepping out, and also the Asian banks, and also this big family office, multi-family office that's being built in Singapore. I think that's going to be a very active and bigger player going forward versus what we've seen in the past 1 decade.
And is that a reallocation from developed to emerging markets in ASEAN as well, you think? Is that a double whammy where the liquidity comes from there as well, potentially?
So that depends very much about their asset allocation.
Sure.
So if their asset allocation is based on geographic or asset classes, they might do that, or they might not do that. But increasingly, I'm seeing investor that is not building its portfolio based on a fixed asset allocation, but very much essentially a barbell approach. So they will have a good element of cash or cash plus in their portfolio. And on the other hand, they will be looking out for trades that will give them convexity, optionality, or specific event or situation. And that's how I see a lot of smart, savvy investors are rebalancing their portfolio.
Understood.
Thanks.
Thank you. Maybe Suhaimi, to you, because you have global but also regional and local investors. So what have you seen evolving over the last 10 years?
Well, I'll tell you this. I mean, I'm not sure about, I don't know if I can comment about how it's evolved over time. But what I can say is this. Since the day we started until today, our investor base has always been high net worth individuals, family offices. We've got institutional investors as well, obviously, reinsurance companies, university endowments, so on and so forth. But the bulk of it has always been high net worth individuals. Even before the term family office became popular, I mean, basically it's the same category of investors, right? And that's because of what we do, what we're targeting to achieve, right? When we first started out, long time ago it seems now, and we told prospective investors. We're targeting, to run a single total portfolio solution, aim to hit 25, 30% annualized volatility and hopefully hit 25, 30% returns, annualized returns. I mean, we had people telling us we were crazy. It was nuts, it wasn't going to happen. But obviously 16, 17 years into it now, not so crazy, right? We've not exactly hit that kind of 30% return target, but we've come close, and it shows people we can do it the way we do it. But it still remains a strategy that resonates well with a certain type of investor, and we're happy with that because we think that there is a wave coming.
Okay.
The evolution to me has been the fact that in the early days when we used to speak to investors, ultra high net worth individuals, they used to come to us and say, I don't know much about hedge funds. You're probably my only hedge fund in the portfolio, but I'll take a bet. I like you guys. Nowadays, there's more sophistication. People understand how to build up a portfolio. They have exposure to hedge funds. So we see that wave coming in terms of not just the volume, but sophistication of the investor as well.
Does that align? I think, Yong, when we were preparing for the panel, you mentioned the private banks were much more important maybe a decade, 15 years ago. So that aligns, therefore, when you're speaking to investors that maybe were using private banks 10, 15 years, and they're therefore much more experienced and sophisticated.
Absolutely. I mean, of course, the sophistication of the family office now has grown. They've got professionals there. They come to you directly. They don't rely on the private bank as much. So I think there's a lot to look forward to in the next few years.
Thanks. Willie, I think your journey's been a little different, and your New Silk Road's journey's been a little different, so maybe you can touch on that, and if you can then dial up to the top and talk about the geopolitical piece as well, because I know you've got a firm view on what's happening there.
Sure. So as a history, firm history, obviously started very small, just friends and family money and a few supporters. But over the years, we were fortunate to be able to pick up a lot of U.S. institutional investors, primarily the endowments and foundations, subsequently pension funds. But I think something that we didn't spend too much time upon, I know Yoni touched upon it for a few seconds, but is that there was a tremendous reallocation from the liquid markets into the private markets by these endowments and foundations over the last 5, 6 years. A lot of these big endowment and foundations, they run 40 to 60% private assets, and that is the same thing in Asia. So we had seen them shift away from more, I guess you call it plain vanilla strategies like ours, into, I guess you could call it more esoteric or sophisticated strategies like private equity and hedge funds and so forth. But we will see them, because of the geopolitics and everything else. It's very difficult to get, for instance, net new assets into China strategies. Almost every call I have with a U.S. investor now is, what do you have that has very little or no China exposure, is the first question I get when I take a call with a prospective U.S. investor, for the most part. But there are new pockets and new large institutions being developed. I think they're aggressively allocating. I was with another big bank this morning, and everybody wants to figure out the roadmap to the Middle East. I mean, it's like the most sought after question now is, how do we get institutional investors from Saudi Arabia, et cetera. But that will shift, and like Yoni said, we are also seeing much more traction from our Asian investors as they get more sophisticated. I mean, Singapore has been a fairly forward-thinking and institutionalized market, but we see the same trend happening throughout the rest of Asia, and we're pretty excited about that. But maybe I'll just end with this, David, is that I think regardless of the dynamics, geopolitics, investor base, this all changes, and there's many cycles. Japan was big and now is again, and not for a while. I think we all have to recognize the strength of our firm, what our process is. I know Yoni has that, obviously Suhaimi, Quant, ourselves with a fundamental approach to investing equity throughout the different cycles. I think we just have to stick with that, adapt to some extent, but also be able to ride through a lot of these changes in investor landscape, geopolitics, differences in markets, and know where our strengths lie.
Thanks. I think Deborah from Allborn on the allocator panel yesterday mentioned teachers going from a 3% to 1.5% allocation to China. Michael Price from the Das family office said there's a beginning to become a convention of looking at long ASEAN. And I think maybe last week or the week before, there was an article out saying Asia ex-China, and then there was a BNP asset management lady talking about requests for proposals for both Asia ex-China and Asia ex-Japan. So for me, how does that play into this? All this talk about Asian allies, but it seems quite, doesn't seem consistent, the messaging there. So.
Just one quick comment on that. I talked to a very large allocator, and the common question about ASEAN is you have to be forward-thinking, forward-looking, because if you look at the historical numbers, at least from a beta perspective, and sad to say many funds, it's difficult to paint the story, especially when you look at it on an absolute return basis, why you need to have an ASEAN allocation. I think many of the economists and Maybank and strategists spoke about it. It just hasn't shown up in the numbers, and that's the difficulty we have in our jobs. We've got all these great companies, they've got good earnings growth, good ROE, but if you look at 10-year stock return of a portfolio of the market, it's very difficult to justify why a global asset allocator needs to have an ASEAN component, because the beta just hasn't been consistently there.
Understood. Andy, from your perspective, having walked the walk?
Well, I think that said, it's still the case for, as you said, Willie, sticking to your strategy and getting the message out there. Because I look at my personal experience. I came out to Asia in 2004, and ended up in Hong Kong. Looked at the growth that was happening in China. But if you look at, even at the Hong Kong market on an index basis, over the last 19, 20 years, then it's up 50%. So if you annualize that, you're getting returns out of the broad index in Hong Kong of 2% per annum. So you're not even covering fees in many cases. So the real story to me is find the specialists who understand the market, who have the experience in the market, who are following the process, and let them make the returns, because passively sitting in an index fund might not necessarily generate the wealth and take advantage of the opportunities that are prevalent in this region.
Understood. I was just actually looking at the Q&A, and someone's directed a question to you. I think you're going to say find a specialist, which might be handy. But private credit is booming. How hard will it be for allocators and prime brokers to provide funding and leverage at the scale, given the volume of deals coming? Not quite sure why it was directed explicitly at you, but would you start by asking Young?
I think Young's the expert there, yeah.
The private credit space, in terms of how you get access and liquidity and funding there.
So maybe first talk about the opportunity. So what we're seeing is a big part of global capital markets are shut. So if you look at new issuance, be it in bonds or equity, they are all-time low. And then banks, as we know after what happened with the US regional banks and Credit Suisse, there is a lot of regulation that's going to come forward. And then what we have is 2024 onward, there's a huge refinancing that's going to come out. The question then is, who is going to fund this guy when it comes due for refinancing? And that's going to come from funds. And the funds manager is going to be getting money from institutions or high net worth or family office, and they will be participating. And what is interesting about this asset class, other than the fact that there's this huge opportunity that's coming up, things are also getting very attractive. So 2 years ago, if you do a deal with Blackstone or KKR or Warburg Pincus, you get something like 8-9% and a loan to value of 70% and relatively light covenants. Today is the exact opposite. Today, you probably can get away with 13, 14, 15%. Nobody do any deal with a loan value of more than 50%, and it's very tight governance. So you have a situation where the market needs you, and you're able to demand your own terms, and it becomes a window of opportunity for everyone to participate. So I do think that this is a cycle that will probably last a few years, and it should do quite well for many investors. Thanks.
Thanks, Young. Maybe just looking at the different strategies here and from putting your old investor hat back on, or indeed if you're looking at it from a Privium perspective, Andy, as a diversified platform of managers, would you look at a group of managers like this as a portfolio and a great way to get allocations to to Asia? I know it's different with a global macro fund in the mix as well, but what would your thoughts be on that? Not just restricted to these fine gentlemen, but other products as well, of course.
But I think it's all about balance at the end of the day, David, and understanding what your long-term objective is for your own portfolio, and taking advice accordingly. I think what we all learned through the GFC and the years afterwards was that, you know, liquidity isn't everything. It often pays to take a longer term view and be able to hold positions and hold assets in a portfolio over the longer run. So I think there's certainly been a readjustment in terms of allocator mindset, and there's more openness to pursuing those opportunities in the right way. I think you know, if you're asking me what my top picks would be at the moment, you know, it's tricky, you know, sharing the stage with these guys because you know, how would you construct a portfolio at the moment? I'd certainly be very interested in any manager that is running a macro strategy that's focused perhaps on rates, credit to some degree, FX. I think there's a good opportunity set to trade the dislocations in that asset class. I would certainly think that CTAs would do quite well and seem to be doing quite well this year. But then you've got to look to the longer term as well. So you know, I think the dislocation in credit is probably the key trade to me over a 2 to 3 year time frame, and then looking out for where else asset classes are repricing, and in that way, then you know, you need a fundamental equity approach that is going to have the courage to invest and stay the cycle.
Thanks. And so Jaime, I know you've talked about QuantEdge envisaged and evolving and being a total portfolio solution. So if you were talking to an investor, you would position yourself as such. And I suppose then the follow-up question, which I've got here, I'll come to in a second. It's not related, but it's quite interesting.
Yeah, look, we are a firm that just provides one product, right? We manage a total portfolio, invest across the globe, and obviously our allocations change over time. I think that's quite pronounced, I think, over the last sort of 18 months or so, right? Where our allocations to bonds, you know, 12 months ago, all-time low, and that's continued, I think, up till today. But our commodities exposure is ramped up, you know, in the last 18 months or so, up to peak to about Q4 last year before we started sort of downsizing. So obviously it changes over time. I think at the moment, you know, just even in the last sort of couple of months or so, you know, equities positions, right? We started out with more exposure to US equities, then we shifted it slightly to European equities. I think in March, when all the banking troubles sort of started, we shifted allocations more to Japan equities. So it sort of shifts over time depending on where we think sort of there's more value to be gained, or which markets are more attractive. But I think there's always somewhere you can make money from.
Understood. There was a good question. We'll come back to it because I want to stick on this theme for a minute. But Willie, from your perspective, when you talk to investors about where you fit, is it the same point about, you know, if you can stay the course during these dislocations, you benefit from it?
Very much so. Because of all the dislocations we're seeing, whether, you know, it's been geopolitics or inflation, there's definitely a lot of opportunities. You know, one of the key metrics we tend to tell investors is you can put together a exciting set of Chinese growth companies for 17 times PE, growing at almost 50% real earnings growth with a dividend yield and ROE of 20+%. I mean, if you present that to a private equity investor, I'd say that they're pretty excited about that sort of profile. Yet many of the private equity companies, no offense to my private equity colleagues, aren't exhibiting cash flow. So there are a lot of opportunities once these markets dislocate. And if you have the right business, the right investor set who can stay the course, we think it's very exciting opportunities in China. And similarly in ASEAN, there are mid-cap companies that are exhibiting the same sort of characteristics and growth and cash flow. So we are very excited about the long-term nature of these companies.
Thanks. And Yong, just to give you the same forum to address that, if you were talking to a significant institutional investor about their portfolio of allocations, how would you position Tahan compared to their other fund manager allocations?
So as I said, most credit manager out there is still trying to run a fixed income strategy. But I do think credit is no more fixed income. Credit is about opportunity. So I'll definitely be highlighting all the dislocation opportunity and also all the opportunity that we're seeing in private credit.
Understood. We've got about 6 and a bit minutes left, and I've got one question here I really want to ask, and there's a few others that are there also. One relates back to AI. So it's been a theme in the conference over the last couple of days, AI, digitalization, etc. So Jaime, they were basically, the question says, in terms of AI and machine learning, is that something that Quant Edge would look at given your quant edge?
Well, you know, it's an interesting question because, I mean, we apply quantitative techniques to investing. I mean, basically that means that, you know, we've always used machines to augment what we do, but that doesn't mean that we use necessarily, and there are a lot of quant funds that don't use AI and machine learning, and I think we wouldn't call ourselves a machine learning or AI firm, right? One of the things that I think is going to come out from this recent sort of craze and hype about AI is you're going to find tons of AI funds suddenly popping up. We're not one of those, right? We don't call ourselves that. But having said that, there are many things you can use AI for at the fringes, right? And we explore a lot of that, right? And a lot of it sort of aids our research. But at the same time, given our philosophy of investing, because we're looking for risk premiums, we want to invest in biases in the market that we can justify with economic theory. And that means you can't just apply AI to look for patterns and correlations. You want to find that causation. So for us, you can apply AI to some extent, but we're not going to use AI to make investment decisions per se. Not yet.
Understood. I've been told we've got a little bit more time, and I know Andy's got some background on this topic as well. So in your previous shop, you were working on a sort of pattern identification software, if I remember correctly, that was helping to generate signals that you could then invest in. So maybe you could touch on that and how that was expressed as a direct investment or using AI to get there.
Yeah, it's a strategy that is very much focused on machine learning but natural language programming, in the sense that the models would take written text, would process that written text, so text out of analyst reports, CFO statements, CEO statements, and attempt to predict what the price action would be based on the historical data set. So it's quite esoteric because it wasn't drawing particularly on financial information. Yeah, it's the application of AI is phenomenal, but to my mind, it's just creating an additional alpha opportunity. You know, you're not drawing your alpha from the same sources, and so the whole problem with crowding, etc., is mitigated by the fact that you're getting a different outcome.
Thanks. And Willie, I'm guessing from a fundamental perspective, it's perhaps not something you would embed in the portfolio, but other data signals or big data that you might look at that would help? Geometric patterns, people going to the supermarket and tracking different supermarket chains, etc.?
We recognize where our strengths are, and it's hard for us to compete against the large global hedge funds when it comes to getting, you know, the latest cutting edge technology. We do use some vendors, for instance, that provide us with some longer term signals and things that we look at, maybe some of the investment banks that we work with also, so we do take that into account, but for the most part, we are still very much of a fundamental meet the management teams multiple times a year type investor. Where we are looking at AI is more from a company perspective, who can benefit from AI within Asia. Right. And we find that there are actually a lot of companies in Korea and Taiwan, for instance, that some have re-rated, others have not, but those offer a lot of opportunities. Everybody talks about NVIDIA, but there are a lot of other sort of hardware tech companies, chip companies, memory companies that will also benefit from the AI cycle. NVIDIA produces all its chips at TSMC, for instance.
Understood. Related to, but I think a little bit more basic, one of the questions was and this perhaps is good to start from the fundamental side, and I'll ask you as well, Yong. Data, availability of data, and I guess that would translate into research as well. How is that available now? How has it evolved over the years? I think, and perhaps also where has it declined in terms of the fundamental side for you?
Data availability has definitely improved over the years. I think the regulators are getting more sophisticated. But having said that, we still feel that it was important to build on-the-ground presence. We spent a lot of time traveling to all the different markets we invest in. One of the reasons why we built the China office is that we started to invest, especially when you're talking about smaller mid-cap companies, you need to do the due diligence on the ground. You know, the research of the sell side is more focused on larger cap companies. So for us, although there is more data available, especially for the emerging companies, the smaller companies, we really still feel like we need to kick the tires and be in country to meet those folks.
Understood. And to wave the Maybank flag, I think we are pretty good in research in ASEAN compared to some of the bulge brackets. Yong, from your perspective, data and credit, how has that evolved? And is it becoming better over more recent years?
I mean, it's similar to what Willie said. I think we do similar things, very much bottom up. So financial data and also kind of on the ground due diligence, those are quite important. But that's more important for the public side of the credit business. The private side of the credit business, you absolutely have to engage the owners and the shareholders a lot more to make sure that you can understand the true insight of the firm, because most of them are not ListCo. They're just privately held companies.
Right. Yep. Okay. And then, Suhaimi, maybe the same question to you. I know the importance, you mentioned the importance of data overall, but I've just had another question come in which is related, saying, have the older school or the older models like technical charts seen their last days? Would you ever use things like that, models that you look at access, or do you build all your own?
Well, we rely on a lot of data, first of all, right? It drives what we do. But having said that, we are living in an age now where I can say there's probably too much data for our own good. So every single month, you've got somebody coming to us and saying, I've got a great alternative data set that I'm going to sell you for, you know, twice what you should be paying. So it is expensive, right, data? And you got to be sort of picky about what you use, because there's a lot of noise in there. So the noise to signal ratio, it's not great, you know, for the most part. So we are quite picky about the data that we use. What I would say there is, you know, we are, you know, the game that we play, risk premium game, are quite long term. So a lot of the signals, sentiment sort of signals that many other funds sort of try to dabble with may not be useful for us. So it really depends on the strategy, I would say.
Thank you. This is an interesting one, and I've spoken to a couple of groups recently. I have a bit of an answer to it myself, but there's a question from the floor saying, what can retail investors do to generate returns or to find returns? Maybe Yong, start with you, as many of the opportunities in private credit are not readily available. Obviously, investing in Tahan's perhaps not available to retail investors, but we have a significant retail franchise as well. So any thoughts on that?
Yeah, so that's a challenge. You have to talk to Maybank. Hopefully Maybank is able to put together a much more retail product. Otherwise, it's true, it's challenging for retail, small amount investor.
Understood. I did speak to a group that was looking at fractionalized investing, so I'm not sure if that's something that will come to the fore, but it's certainly possible. Andy, from your perspective, is there any thoughts you have more broader than private, but across hedge funds? Have you seen that sort of interplay between private banks, retail investors, what they can do or what they could be doing to get access to alternative strategies? And that actually relates to another question that I received, which is, is this a sort of hallmark or a barometer now of a move away finally from passive strategies? And my follow-up would be, is that related to QE? Was the passivity driven by, or the passive interest driven by that as well?
I think it's tricky, David. So because of the level of regulation and the protection around that, and the fact that yeah, your hedge funds are still in the racy bucket, right?
Yep.
Any alternative investment. So I think it's more a case of, you know, how can you structure and make these products accessible? David, you've spent time in Australia, and you know, one of the developments down there was to roll hedge fund strategies into listed investment companies. So this meant that retail investors could buy the fund as if it was a share. Now, there's a degree of risk around that because quite often the value of that fund doesn't move in lockstep to the valuation of the underlying securities that the fund holds because it's a market. There's a bid and an offer. I've not yet seen that be introduced in very many other locations. I don't know if that's ever been considered for Singapore, but it is a means by which these strategies can be accessed by a different investor base.
Understood. Couple of other topics just to land on before we wrap up. As business owners as well as portfolio managers, what keeps you up at night? It's what might you be fearful of? Maybe Yong, start with you.
Too many things. I mean, I remember when I was at UBS, the balance sheet that I used to run is easily 50x of what I run today. And guess what? I'm up most of the nights because, like you said, there is portfolio performance and portfolio risk, and then there's also business issue. You know, making sure that you are reaching out to the right type of clients with the kind of same like-mindedness. So there's a lot of things that you have to consider. Yeah, I think it's better to be a PM than to be an owner of the business.
So, Jaime, from your perspective?
You know, I think I sleep pretty well at night. I've got a pretty good team. We're always looking at, you know, the risks, whether it's market risk, counterparty risk, whatever it is. We're always trying to, you know, think about ways to get ahead of these issues, right? In many cases, we've sort of been ahead of the market in terms of, for example, pushing for margin segregation, things like that. So whatever it is that we could do to protect not just the business, but the fund, because we're investors as well. So we always want to be taking the initiative in terms of addressing all those risks. So hopefully I won't have to stay up late at night.
Fair enough. Willie?
I think I'm going to echo a lot of what Yoni and Suhaimi said, because when I talked about a repeatable process, I think we've all developed repeatable processes. That's probably why we've been around for as long as we've been around. But the process isn't just the investment process or the quant models, but it's about building the organization around that. And here I'm talking about the right people, the right clients. So there's a lot to go into to make sure that you have the right firm to be able to execute the investment process. And on top of that, our funds are probably the largest investments we have personally.
Of course.
So when, you know, our markets go down and our funds go down, there is a substantial sort of personal impact it has too. So I think all those elements make it being a business partner and owner difficult. But on the flip side, the benefit is you have a lot more alignment of interest too with your end investors when you are substantial equity owners in the firm and also investors in your own fund. So I think that's important to us, is being aligned with our investors.
Thanks. And Andy, from your perspective, I guess, having talked to a lot of managers over time, what today at Privium, as part of the management team, what worries you? And then also the other managers that you've dealt with and invested with over the years, what's been worrying them as business owners?
I think it's sustainability of the business. You know, it's keeping people enthused, you know, holding them to the dream, because it's a tough environment at the moment to start newer funds and to find your space in the business and to grow from there. So I think it's more a case of you know, how can our partners be encouraged to persist in what they're doing. Obviously that impacts our own profitability as well. We want our partners to grow because we have a degree of alignment of interest in the growth of those businesses. But can't say that I'm losing much sleep at the moment though, Dave. You know, I'm deep and dull all the way. Yeah.
Understood. I had a question here saying what role does alternatives, or what role do alternatives play in corporate investing and treasury excess cash management? I guess, and that's asset liability as well. Again, maybe Andy, start with you. Have you talked to managers? Have you represented that in a sense? You've spoken to actually end investors that are talking to you as well as treasury and cash managers, right?
I think it's certainly where there is excess capital, people feel the pressure to make returns on that.
Mm-hmm.
But we are in this, we're in a cash environment at the moment where you can generate pretty good returns from staying in cash. So why would you necessarily need to seek a higher level of yield on the investment currently? But again, it's a matter of matching the strategy with the end result as well. It really is a case of you've got to find the right investment for where you need to go.
Understood. Maybe Yong, you obviously spent time dealing with treasury and finance back at UBS as well. So do you have a view, if you were speaking to a treasurer today, say at a big reinsurance firm or maybe a Japanese lifer that had these asset liability mismatches, where would you think, not just necessarily Tahan, but alternatives as a segment, where would they fill a role for that type of money?
So I think what's key is really the investment objective and their investment horizon. So recently we do have a corporate investor into our private credit fund, and it's a very sizable allocation. So the interesting thing is, they're happy to take part of the balance sheet and be put into a bucket that is relatively less liquid. And the main reason is because they feel that the investment return is totally uncorrelated to their underlying business. And that's very important to them. And also the difference between private credit versus private equity is because you collect your coupon every 6 months or 12 months and you get your repayment in 1 or 2 years, there is indeed a certain level of liquidity coming through.
Okay.
So increasingly I'm beginning to see some of this corporate guy that has got spare money looking at longer term and trying to get invested in areas that is totally uncorrelated to what their underlying business is.
Understood. So Jaime, Willie, do you have a view on that one, or shall we?
Well, I can't say why corporate would do it, but we do have corporates investing. We have listed companies investing, foundations investing. It really depends, as was mentioned, what their strategy is in terms of treasury management. But I'd imagine it would be, we're managing the rest of it pretty conservatively. How about pick out a small slice and put it into Quantage and see that 10x possibly happen? We can't guarantee it, but a moonshot once in a while, it's worth a bet.
I think your track record speaks to the ability of at least a replicable process. So. Willie, would you have a view on that one?
Not too much. I think our strategy is sort of volatile enough. We do have some corporate investors, but it really is in their more sort of equity risk bucket as opposed to sort of a treasury management perspective.
I got it. I've got a much better question for you, and I think this is the last one before we wrap everything up. This is actually framing a question much nicer than I was going to ask, but what would you wish for from Asia and ASEAN, the ASEAN ecosystem, in terms of evolution of the markets and next stage of alternatives? So I guess starting with you, if you look at the ASEAN markets that you look at, what would you like to be seeing, whether from a regulatory or from a markets perspective?
I think somebody mentioned this yesterday, but we definitely need better liquidity, and hopefully Maybank can help us with that across the ASEAN markets. I think there needs to be a little bit more focus of shareholder return by the corporates, deeper markets, and then as I think we will also get that as the local institutions and the families come into these markets, their own home markets. So that's what we're really hopeful for, and I think that will present a great multi-decade story, just given the growth and demographics of many of these countries.
Fantastic. Look, if you'd all join me in thanking Yong, Jaime, Willie, and Andy, I've really enjoyed this, and thank you for your attention.